Hi, everybody. Today is Tuesday, March 3rd. I'm Mike DeAndre, and let's discuss the coronavirus. Okay, so before we get into the financial situation, the financial response, I did include in the email some links to these websites. Johns Hopkins has a website, CDC has a website, worldometer.info has a website, WHO. So these are places where you can go and get some more information. I don't want to take a lot of time discussing them in this video, but did want to include those links for you to go back and review if you find that helpful for yourself. Okay. But also, let's start with some financial perspective. So, has the market responded positively or negatively to pandemic scares before? So, yes, we look at the SARS, the H1N1, and Ebola viruses, and let's take a glance back to the financial performance during those scenarios. So, if we look at these three, what we're looking at here are the max drawdown during the life cycle of each virus or each disease. So during SARS, H1N1, and Ebola, we saw domestic equities pull back anywhere from 12 to 15%, sort of as the max drawdown during the scare, and international equities anywhere from, say, 15 to 27%, and even bonds had negative return periods during each crisis. But by the end, once we moved from first diagnosis to the ultimate resolution or the perception of the situation being under control, markets returned largely to a positive stance. Okay, and we're sort of still in that max drawdown period right now. We'll look at that in a little bit more granular data, but we're still in that early drawdown period where it's very uncomfortable. There's less certainty, and there's a little bit of fear gripping markets, but that is really normal. That is what we've seen in the past, and there's a high probability that we'll work through this like we did in previous scenarios. So historically speaking, just to put some context, because we have the virus and we have the medical situation, but what's unique right now is in 5 trading days, we've seen, actually in the last 8 days, we've seen an enormous pullback, about 12% in domestic equity markets. So these are the 54 occurrences in which the S&P 500 has pulled back more than 7.5% in 5 trading days. Okay, but all of these occurrences happened in a weak domestic equity market. Okay, when the S&P 500 is trading below its 200-day moving average. Would anyone like to venture a guess how many times this has occurred when domestic equities are in a strong posture, or we're trading above our 200-day moving average? Any guesses? Well, if you said 2, you win. Winner, winner, chicken dinner. So if you guessed 2, only twice before last week had we experienced a 7.5% or greater pullback in equity markets in a 5-day period. Okay, it's a fairly rare occurrence. We're going back to 1950. This is modern market. That is not a normal situation. Sort of the silver lining, if you will, is after those 2 instances, markets saw positive returns. Okay. So there was the pause that refreshes, or the cleansing correction, however you want to refer to it. But we saw a pullback, in this case of 8.54 and 8.23%. And then a week later, a month later, 2, 3, 4, 6, 9 months later, 1 year, and 2 years later, all of those data points later, every single window, every single time period had a positive return. Now, I can't just copy and paste that over and say, hey, 2 years from now and every data point along the way, we're going to have positive returns. I hope that is the case, but at least that helps give us some context. Before last week, we're 8 days from a market high. Okay, so we were very much in a positive trend. We were a strong trending domestic equity leading market before this happened. So the coronavirus, the fear that gripped markets a week ago, is revealing itself to be a rather powerful gripping experience for a week there. Where the field position and where we are as a market would indicate that we're poised to endure this, and that equity markets can take this hit, and probabilities in at least historical context would suggest that we have a shot to continue the trend that we were on previously. We're not out of the woods yet. We have a little bit of work to do working through this price correction, but that's the historical context that we're working through. So, as it relates to this particular drawdown, let's take a gander looking back since March of 09, how this pullback relates to other pullbacks we've seen in domestic stocks. So this is a chart I like to reference on a fairly frequent basis, courtesy of Doug Short. And this is updated as of February 28th, which in this case is perfectly fine because we have not pulled back more than Friday's close, down 12.76% in the S&P 500. But this just gives you an idea of the frequency of pullbacks we have experienced since the bottom of 09. So you can see pullbacks between 5 and 10% happen fairly frequently. In fact, the only time period we don't have a pullback of that magnitude is in 2017. Right now, we're trading between down 12 and down 8 since Friday. Monday was an up day, and today we'll see how today closes out. But this is the range that we're trading in, and it looks like to be a very normal range for a normal, to be expected type of equity correction. Okay. Now, the steepness and the quickness that we've done it, as we've stated before, is what's kind of unique to this scenario. This bright red line is in the Dow Jones Industrial Average, compared to 3 other scenarios we've seen in the last decade where we had serious corrections in equity markets. And you can see this is pulled down the quickest, the steepest. It didn't have. We are not sort of exceeding the drawdowns that we saw in those other pieces in those other time periods, but you can see just how quickly this thing has pulled down, and it's likely that we're going to begin to work through that sawing back and forth time period as equities sort of prove out where the floor is. We can't say that we have the floor in or that we have the bottom and that this is the time to buy yet. We're still very early in this, but I just wanted to give you some context on how quickly this has taken place. Sometimes when they're super steep going down, they're super steep going back up, and we may get a V-shaped correction out of this, but it's too early to tell. So what hasn't changed? Domestic equities are still in first position in our global rankings. That's huge. That's important information. Now, I will point out that international equities has fallen to the 3rd slot, being replaced by fixed income. But domestic equities are still in first position, and by a rather large margin, with scores around 326 versus just around 200. So that's a fairly strong position that we find domestic equities in. When we look at ranking money market against all other investable assets, we see money markets only scoring 9.15%. So and this is a fairly sensitive measurement tool. We're very much in the lowest quartile, very much the bottom of the lowest quartile of money market rankings. So there's nothing that is dramatically pushing us out of equity positions today. If we stay in that 12.5% pullback range and begin to chew sideways and then V-shape out of that, we're going to be glad that we held these positions. We don't want to go too much further than the 12 that we've seen. I think it's reasonable to expect that we'll retest that number before we make new highs. But this is where we are. These are the facts. These are the numbers. Where cash is only ranking 9.15 against all other investable assets. U.S. stocks against all other investment assets. So domestic equities are ranking 89th. Or in the at 89%. So that's a very high ranking. That's a very strong ranking. If you look back to 2012, we had that pullback in 11, and since then, domestic equities have been scoring very, very high. So there's a number of data points that are directing us beyond what we would be getting out of the sound bites, out of our politicians, out of the news cycle, where there's nothing but fear, nothing but stress, nothing but anxiety. The data points are telling us, hey, step back. History is telling us we've been here before. We've seen it with the previous epidemic pandemics. There is a period where we have pullbacks. 12 to 15% are very normal in that period. We're at 12% right now. And let the process work itself through. We have to be mindful, watching the data, making sure that we stay nimble and we stay alert. We don't want this to turn into a larger correction and not take action. But the data points as of today are saying to let the money ride, let the positions that we have in place work through, and obviously I'm monitoring this multiple times throughout the day. And if you have questions as they relate to these scenarios, whether they be from the medical side or for your specific portfolio or the holdings or anything at all, feel free, reach out. I'd be glad to chat with you about your situation. Take the normal precautions that you typically would take. Wash your hands, get plenty of rest, eat well, exercise, do all the things you do already to take care of your health. I wish you the best, and please let me know if you have any questions, and I look forward to chatting soon. Take care.